So some of the core objectives for exit planning. We want to turn taxable liquidity events into a tax-efficient income stream. We want to protect and leverage the capital. And then we want to optimize that wealth transfer from an estate tax standpoint. Anything over those thresholds are often going to result in a federal 40% estate tax. And that's what we want to help business owners avoid. One of the key ones that we can use here would be a Section 409A, and that's going to be a non-qualified deferred compensation plan. Basically, what you're looking to do is defer a portion of compensation before the sale, pay it out over a 5 to 10 years post-sale, and it will reduce income in high tax sale year, smooths out the income into lower brackets going forward. And it can be used in conjunction quite nicely with corporate-owned life insurance to informally fund it. The second one is, like mentioned in the aforementioned, but corporate-owned life insurance. It's a powerful balance sheet asset pre-sale. The business buys life insurance on key owners and builds a tax-deferred cash value that could be included in the assets or the P&L. The benefits of this is it offsets deferred comp liabilities, it creates a tax advantage liquidity bucket, and improves balance sheet optics for those that are looking to acquire that business. Third one is an executive bonus plan or a 162. So under Section 162, a bonus key employee or an owner pre-sale could use that bonus to fund life insurance. What this would do would give an immediate tax deduction, retention of the tool pre-sale, so they can pick whether it's owner owned or if it's business owned, and then creates a personal asset outside of the business if it's not business owned. It's also a great way to retain key employees and reward them for 5, 10, 15 years of loyalty to the company doing good work. Another great one, and this is one that's widely used by medium to even larger size companies, is split dollar life insurance. They're great for larger exits, usually $5 million and above. And the strategy here is a company and owner would share policy benefits and build cash value within it, and then structure it as a loan or an endorsement. So they would either gift it to the employee, or the employee could use the cash value inside for some liquidity in the form of a wash loan, in which they could get that money and get at it tax-free. The benefits of it's really going to leverage dollars more tax efficiently. It shifts the value out of the estate of the owner, and also out of the recipient, and then it's minimal current tax cost if structured correctly. And then finally, we have another one. This is something that's kind of grown a little bit more popular in the last few years, is an intentionally defective grantor trust. This moves the future appreciation out of the estate. One could sell minority shares to the IDGT pre-sale. It freezes the cost basis or the estate value and allows future upside to escape estate tax. Income tax paid by the grantor will actually be covered, and then it will provide more wealth to transfer over to the recipient or the heirs. And then we also have another one. This is more kind of on the lines of what we call a supplemental employee retirement plan, or SERP, which a lot of you are familiar with. It would be a cash balance plan or a 401k plan. It's massive pre-sale deductions. You can max out your contributions in 2 to 3 years pre-sale, and typically can shelter up to 100K to 300K plus a year, depending on your personal tax bracket. And it reduces taxable income leading into the sale. And then finally, we'll reiterate on the CRTs, or the charitable remainder trust. These are pre-sale only instruments. So we need to really get to you, at minimum, roughly 8 months before you see a large windfall. It'll transfer a portion of business interest into that charitable remainder trust. The CRT will sell tax-free. And then the benefits of this is it defers capital gains, creates a lifetime income stream, and also provides a charitable deduction. Another one we've seen that is very, very popular over the last 4 or 5 years that we're seeing larger firms look at is deferred sales trusts. This is a hybrid structure using installment sale concepts. Mostly what you're going to do is you're going to sell those assets to a trust. The trust sells that to the buyer, and the owner receives payments over time systematically, lowering what they would receive in whole, allowing it to take it systematically and reduce the taxes. The benefits of this is it's going to defer the capital gains. It creates a flexible income stream that the recipient can control within their tax bracket, but it must be properly structured. You usually are going to want to have a tax attorney and a CPA kind of helping you quarterback this, and we're more than happy to kind of show you the outlines of it. Another one is running a pre-sale bonus and insurance arbitrage, which is a fairly underrated strategy. It issues a large bonus that is deductible. It uses after-tax dollars to fund life insurance, and it creates a tax-advantaged growth bucket as well as future tax-free access that you can use via a wash loan with a permanent policy. So essentially the step for this is going to be, one, you're going to position the asset before the sale. How it's structured or where it sits matters. That's going to be a part of the strategy. We're going to move excess cash off of the balance sheet, and we'll fund either insurance vehicles, qualified plans such as a SEP plan or a simple or a 401k or any other employee, even group plans can be used, and then they'll be used in conjunction with trusts. The reason why we do this is it creates clean business financials, and it prevents double taxation on trapped cash within the entity. So some key takeaways here, and just to speak simply on it, would reduce taxes from the liquidity event. It'll convert business equity into sustainable retirement income for the recipient. It protects wealth and transfers assets efficiently. And in the form of CRT, it creates a philanthropic or family legacy. And then you would always want to coordinate these, planning initiatives with a financial advisor, a CPA, and/or attorney.